This is our Forex blog for July 30th, 2013, and these are our currency indexes, which allows you to see each currency as a chart, and it lets you see a wealth of information. In other words, the yellow line here is called market profile technology, and we actually calculate it for all of the pairs that we compare the euro against: euro dollar, euro yen, euro pound. And for the index, this is the price most actively traded for the previous day, and the orange one is last week's most actively traded price. Hourly moving average in gray, 15-minute moving average in green. You can see the real-time statistical trend, the daily, weekly, monthly trends underneath that. And basically, you want to see what each currency is doing. You just simply want to buy the strongest currencies versus the weak and sell the weakest versus the strong. It's that simple. There's not much else to do other than that. If you are in two of the strongest and weakest currencies, you're going to tend to find 20 to 50 pip moves, and that's really what it comes down to. So let's scroll these back and take a look at all the wealth of information that seeing each individual currency itself gives you. For instance, the pound trend was strong, however the weekly and monthly trend's down, and it found resistance at the previous week's most actively traded price, and it's at our outer containment bands, which typically contain price. Price, when it hits these bands, tends to reverse. So you want to trade with the trend until the market gets to or sometimes above the upper bands, and then look for counter trend trades. It's that simple. And because these are all charts, you can see patterns and buy pullbacks, trend line breaks, Fibonacci profit targets, Fibonacci retracements, and so forth. You can also see support resistance. So the fact that the pound has a weekly and monthly trend that's down, came up today and double topped right here, maybe even triple topped at a major resistance area. You could say when it breaks this trend line here, you're going to go short. So you're short here around 415 in the pound. So which one was the strongest at 415? The euro was very strong. It's also potentially up near its highs because it's near the upper containment band. 415, the dollars, was strong before. Had a little bit of a pullback. It might, try to make another wave up. 415, the yen just broke from underneath to above its hourly moving average and it's going sideways. So this is a pattern that's very likely to continue because the last move was up. It's kind of going sideways, not even pulling back. There's no weakness at all. The only thing bad about the yen is that the weekly trend's up, but the monthly trend's down. But 415, it makes sense to look for a pound yen sell. It's that simple. And most of the time, when one currency is strong and the other one's weak like that, you're going to get 20 to 50 pip moves. So let's put the pound yen on here and take a look. Again, at 415, the pound very likely reversed down. The yen is very strong at that time. And you can see it kind of drifted down a little bit. 415 is going sideways, breaks down right here at 150.50, and pretty much goes down for 6 hours. It falls over 100 pips. You're never going to catch all 100 pips, but it went down, kind of went sideways. You probably would have got out of part of your trade here and maybe put your stop here. You look for a little pullback trade. Whether you got out of that with a small loss or small win or held and made 40 or 50 pips, it's up to you. But this is how you use the currency index to actually anticipate future trend direction before it even happens. For instance, the yen was very strong, had a big move up. Typically, strong moves retrace 50 to 62% fib level. This one retraced to the hourly moving average, which also happened to be the 50% Fibonacci retracement. Then it didn't bounce off that. So if you took a trade there, you might have had a loss or even break even. If the yen's kind of going sideways and the other currency's going down, you can still make 10 to 15 pips. When one's exploding up and the other one's exploding down, you're going to tend to make 30 to 15, sometimes 100 pips. 62% retracement holds. You can wait for a trend line over the highs that get broken, and you're in that trade here at 10. So what's the weakest one at 10? Well, the pound has been trending down for hours, and it's at the lower containment band, more likely to reverse up. The euro was strong all day, and it's just kind of sitting at the hourly moving average. This one is exploding up too. So more than likely, you're going to want to trade another currency against the yen. So we'll take a look at the Australian real quick, see if at 10 o'clock it was either going down or likely to go down. 10 o'clock, this one just kind of exploded down, or actually this one has had extreme weakness before, you can see it was way underneath the lower band, and at 10 o'clock it actually kind of worked its way up a little bit, had a little bit of a pullback, and you can see at 10 o'clock, it's had a pretty much a flat top right here. It's a wedge pattern. This one's very likely to go up. This one's extremely weak. The yen was quite strong on the move up. So at 10 o'clock, you're looking for Australian yen sell. It's that simple. Let's bring this up. 10 o'clock on here, and you can see it's exactly what happened. You had a nice little pullback on here as well. You had to wait maybe 10 minutes for the trade to happen. You put your stop over here. You're not even risking 10 pips here, and you can see it fell 10, 20, 30. Maybe you got out of it only with 20 pips, or if you held a little bit longer, you might have made 40 pips. But the point is, the currency index made it so easy to identify one currency that was strong before, had a nice pullback, it's likely to continue up. Another one that was extremely weak, off the charts weak, the daily, weekly, monthly trends down. This is a no-brainer trade right here at 10. It's a no-brainer trade. Not only are you making 3 to 4 times more than your risk, but it's also, when one's super strong, one's super weak, probably close to 70–80% likely to work. That's how you use the currency indexes to buy and sell the best currencies. And it also, I would say, is a leading indicator, because when one currency is likely to go down and another one's likely to go up, you're in the absolute best currency at pretty much the best time to get in, with the lowest risk, highest odds, and also the highest odds of catching 30 to 50 pip wins for short-term 30 minutes to hour and a half trades, which is what everybody wants.